Good morning, everybody. I promise you I will talk for more than 10 minutes. You usually have to take the mic away from me. It's great to be here at TEXPERS. My name is Paul Nasser. I'm the CFO and Chief Operating Officer for a Boston-based real estate company called Intercontinental. We have about $13 billion in assets under management. We have about $1.8 billion here in Texas alone with 24 different properties. So we're very familiar with the state of Texas, and it's been very beneficial to the performance of our fund. Today I'm going to talk a little bit about what's happening in real estate and some of the things that we're watching carefully and where the opportunities exist. So what are the things that we're watching a lot these days? Obviously, top on the list is some of the geopolitical issues that are happening in the country. And while none of us can control those issues, they certainly affect everything that we're talking about. And so we're keeping an eye on those that definitely will affect supply chains. You know, you've heard a lot about metals that come from Ukraine in particular. There's just a lot of issues that need to be watched carefully, and we're doing that. And these sanctions and other things affect companies here in the US. And those trickle down, and we've already heard about how eggs cost more money and milk cost. I mean, it just trickles down to everything. So we are watching this very carefully. When there's dislocation in the market like there seems to be today, guess what? There's opportunity as well. So we just need to take advantage of that. COVID I put on here only because it's over, in my opinion. Obviously, if there's some outbreak, we'll have to deal with that. But finally, COVID seems to be in the rearview mirror, and that's a great thing for us. And it's a great thing in particular for corporate America, getting them back to work. And we'll talk about how they go back to work in a minute, but definitely something that we are glad to see be in the bag. We've already heard a little bit about inflation. And this is something that we definitely need to pay attention to. Originally, I think the thought was that inflation was going to be temporary because it was based on supply chain issues, logistic issues, and those types of things. And while they still exist, I think real inflation actually seems to be holding on to us a little longer than we thought. In particular, where I'm seeing wage inflation hit is, inflation is wage inflation. Okay, salaries are definitely going up across America. Employees seem to have the upper hand in negotiations. I know that young people are leaving their job and going to the next job for a $30,000 raise, for example. I'm hearing that more and more. So wage inflation as part of the overall inflation is something that's really taking hold. Now, the good news is inflation in real estate is a good thing. And the reason it's a good thing is that most of the leases that real estate managers sign have CPA increases in them. And so those get bumped into, or CPI increases, those get bumped into the lease calculations, and the rents go up based on some of the inflation pressures. So not such a bad thing for real estate. So let's talk about interest rates. That's obviously key, especially if you're using leverage. And interest rates in the last 3 weeks went up 100 basis points. Now, all in, they're still 4% thereabouts. So historically, they aren't really that high. But 100 basis point change in the market in a very short period of time causes people to panic a little bit. When you can buy a multifamily property and do an all-in rate of 3.2%, and then the next day it's 4%, it affects your underwriting, and you need to pay attention to it. So interest rate increases are something that we have to really be careful of. I'm not an economist, but the Fed, seems to want to raise rates, and so we'll have to see how aggressive they get. They have a tough job. They are definitely threading the needle, because if they raise rates too high, then it's going to definitely tailspin us into a recession. And if they go too slow, it may not be the correction we need. So we'll have to watch that really carefully. So let's talk about where the markets are, and I'll get into some detail. These are sort of what we refer to as the 4 food groups. office, retail, industrial, and multifamily. Most investment managers spend a lot of their investing in these 4 property types. And so I want to just sort of show you 2020, when the pandemic first hit, these statistics got hit really hard. I mean, people just didn't know where the markets were going to go, and everything flattened out, and some asset classes actually declined in value just because people were trying to figure it all out. In 2021, as you can see from this chart, things really started to pick up. Real estate has been a phenomenal performer during COVID. And I really project that it's going to continue to do well as a hard asset that you can touch and feel, that you have income coming on it on a daily basis. Real estate is going to be the buffer for some of the instability that is in the world today. I think real estate is going to be a place. So let's just look at this. Apartments, the rental growth in 2021 nationwide was up 13.4%. That's incredible. You heard from one of the previous speakers, Austin, Texas rents were up, almost 40%. That's tremendous growth. Now, it's tough on the renters, obviously. I mean, that's a lot of chunk rent to pay when the next renewal comes on your lease. But the rental rates in apartments have recovered phenomenally. And as a result, you're seeing the forecast even for additional rental growth for 2022. Office, we're going to talk a little bit about office in a minute. Office has been relatively neutral. And I'm surprised by that because everybody wants to talk about office. Are people going back to work? What's going to happen? How are they going to go back? Are they going to take less space, more space? I'll get into that in a little bit. But office, even though there's that uncertainty, has remained fairly neutral. The darling property type is industrial. And I always tell this story that when my 80-year-old parents buy stuff online, I know the digital economy is here to stay, right? If they're getting Amazon boxes and UPS boxes coming to their house, then that means the digital economy is here to stay. And this started even before the pandemic happened, but now it's really taken hold. We're all buying online. And not just hard goods, we're buying everything online. So the need for that materials to be stored is put tremendous upward pressure on industrial. And you've seen significant rental increases in industrial as a reaction to the digital economy. And I feel like that's going to continue. We're only about 23% of the industrial buying that needs that storage is currently happening in the United States. It's only going to grow from there. As more and more people get comfortable with buying online, those materials have to be stored somewhere. So industrial is going to see steady increases. Retail took a significant drop during COVID, right? I mean, and mostly it was segmented to the malls. The malls in particular took it on the chin. They've slowly recovered, and retail as an asset class has come back a little bit, but retail was already starting to have issues, again, because people were buying online. And so the retailers that seem to be doing well are kind of in 2 categories. Grocery-anchored shopping centers, because we all got to buy our groceries, and typically those centers will have a CVS or a Walgreens attached to it, and a few mom and pops in the middle. Those centers did great during COVID and continue to do extremely well even today. And then lifestyle centers seem to have done well as well. Centers that have not just retail, but have some entertainment component. Maybe they have some multifamily on the side, something where you have this mixed-use environment that you want to go there. Maybe your intention was start to go into a store to buy a particular thing, a pair of jeans, but then you end up going to a restaurant there and you go to the Apple store to buy a power cord. So the places that attract you in and then get you to go to a couple different stores, they seem to be doing well. The malls, we have to see where the malls go. And the big box, Usually stores like Sears, doesn't exist anymore. Other large retailers like Macy's and JCPenney and whatnot, they're struggling. And so we'll have to see how that goes. And then if you look at the vacancy rates, the only asset class that's really still struggling is office. And the other asset classes, the vacancies are fairly low. And the forecast is to remain fairly low or to go down. So real estate is really poised to take advantage of what's going on. It'd be a little bit more choppy, you have to be careful, but I think on a go-forward basis, the prognostication is good. So let's talk a little bit more in detail about the 4 food groups and kind of our perspective on it and see what you think. So apartments, when in 2020, it seemed like all of our major cities, everybody just vacated, right? All the young people that lived in those cities, they left. They went to the southeast, the southwest, or they went somewhere, or they went with mom and dad, right? And now they have come back to the cities in a pretty big way, all right? I mean, we had in the pandemic 2 of my 3 children move in with us. It was great to have them there, but I was a little bit anxious to get them back out the door. And finally they went back, and they didn't go back to suburbia. They went back to the city because that's where their friends are, that's where they perceive the action to be. And so there's been a nice recovery in urban core apartments, but at the same time, suburban office has really benefited as well. It's still doing incredibly well. Apartments. And so apartments generally are doing very well, and I think will continue to do well. And if things get tough with construction costs and there aren't as many apartments being built, that's only going to put additional pressure on rents. And so I think apartments are going to have a long run to go. We talked a little bit about industrial. The only issue I have with industrial today is the cap rate, or basically the price that you pay on these industrial deals because it's such a popular asset class, it's just gotten very expensive. And so, when you buy industrial, if it's not multi-tenanted and it's single-tenanted, you need to make sure that you're leasing that space to a really good credit. Somebody who's going to be there for the long haul and pay their rents, because that's what we're relying on, given how expensive that real estate is. Retail, we said, continues to be in a transition. It was in a transition, as I said, before the pandemic. It remains in a transition, but there's some really good opportunities out there. We were bidding on a grocery-anchored portfolio. Most of it was in New England, and it went off at just above a 4 cap. And if you looked at that retail portfolio 2 years ago, that would have been probably a 5.5 cap. And the cap rate is how we measure the value of a property. The lower the number, the higher the value. And so you're already seeing retail, as I said, in the specific areas, coming back in a big way, especially grocery anchored. So let's talk about office. I think every time that I meet with a consultant or frankly anybody, they want to know about office. What's going to happen with office? Where do you think it's going? First and foremost, I'd say office is not dead. Okay, I know a lot of people have said that. It's not dead. And it's not dead for a couple of reasons. One is that it's really impossible to maintain a corporate culture on Zoom calls. You can do it in the interim while you're getting through a pandemic, but you can't do it long term. Second, you cannot onboard new employees on Zoom calls forever. Okay, the way I learned the business was to be over the shoulder of my mentor and watch and learn, and doing it vis-a-vis Zoom, and I'm trying to aging myself in terms of technology, but to do it on Zoom is okay for the short term, but it's not okay in the long term if you really want to develop young people. So I don't think office is done. I think it's got to be here. The question is, how will it get used? Certainly no one in corporate America, in the office world, no one seems to be going back to work yet 5 days a week, okay? And I think it's more of fear. Senior managers are afraid, oh, if I go back 5 days a week, I'm gonna lose all these really valuable employees. And I don't know if that's true or not, but certainly that's the threat that I think many CEOs in America are fearful of. So you've heard this topic of going back in a hybrid way. And that means going back maybe 3 days a week in the office and 2 days at home. And then kind of see where it goes from there. And so the number of days in the office, in my opinion, is critically important to the usage and the long-term space needs of corporate America. And what I mean by that is if you're coming to the office for 3 days a week, then there's probably not a need to reduce your space needs. If you're gonna have, especially if you're gonna have everybody back on the same 3 days, which seems to be, based on the surveys we've done in our portfolio, it seems to be, not everybody, but the majority of people are saying, hey, we're gonna come back Monday, Wednesday, and Thursday. And Tuesday and Friday will be work from home. So if that's the case, and if that's the average across America, then I think the space that already is leased by companies will stay the same. They won't need to reduce it, because when everybody comes to the office, they need a space to sit. So I don't think that that's going to affect it. Now, if, you've heard early on in the pandemic, some companies are saying, hey, we're going to work from home forevermore. And, I have a hard time believing that, but if that's the case, then obviously they don't need office, right? I mean, if they truly are going to work from home for the rest of their corporate lives, then that will have an impact. I think that's a very small majority of companies out there. Quite frankly, as I said, in our survey, and we have over 30 million square feet of corporate users across all property types, it seems like everybody's going to come back to this 3 days in, 2 days out, which I think at the end will mean that office is going to, you're still going to need office. And that's why I started with saying office is not dead as a result of that. Time will tell, we will see. One of the things that will be really interesting is to say to folks, okay, you're going to come in 3 days and you're going to work from home 2 days, and whether or not corporate America gets enough courage to start saying, well, now let's go 4, and then ultimately get back to 5. And, time will tell on that. So this leads me to the last part of my conversation, which is about the debt markets. And it was interesting to hear the gentleman before me talk about the private markets, and he's absolutely right. The private markets, there's a place for that today. And the reason for that is there is some concentration risk that lenders don't want to have. They don't want to have a lot of exposure to any one borrower. But more importantly, the traditional capital market providers, the banks and the insurance companies, they just don't like high leverage, okay? And they got burnt several times in several recessions. So they tend to be 65% or under for leverage. And where the private markets can make hay is above 65% to wherever. And I do feel like there's a definite window for that for those of you who use more leverage. A lot of times when I talk about leverage, I often will say that I don't have much hair left up here. It's because I worry all the time. And leverage, in my career, leverage has always been the thing that causes problems, in my opinion. If used appropriately, you can really get great returns off leverage, but you need to be careful how much. And you need to really balance that based on what kind of property you're investing in, what kind of turnaround that property is expecting. So be careful of leverage, especially in times of uncertainty. Clearly there's opportunity there, right? Because you're filling a gap that someone else is unwilling to provide, but you need to be careful about it. So what are some of the things that we're seeing right now? So we saw interest rates bump 100 basis points in 3 weeks. And the indexes that we borrow against are either treasuries, the 10-year treasury typically for long-term hold properties, or this new term called SOFR. SOFR is the replacement for LIBOR. It can be either fixed or floating. So those indexes have gone up significantly. But still, historically, they're pretty low. On top of the indexes going up, we've also seen spreads go up, okay? So this is my glass is half empty conversation for a moment. And that is that if interest rates continue to go up, at some point, there may be a need to reprice assets. Now, the reason I don't think that's going to happen is because real estate has been and has declared itself an asset class that many institutional investors like yourselves have gotten comfortable with, have seen long-term performance from, both a reliable income stream and appreciation, and the prognostications going forward are solid. So I think you're seeing a lot of capital come into the space. And when there's a lot of money looking for deals, that keeps pricing up. And there really isn't much of an alternative without some risk outside of that. So the dynamics for real estate are quite positive right now. And I think that you'll see more and more money go in. Now, at some point, if the Fed gets too carried away with interest rates, then that's definitely going to slow us down. But is it going to stop us? I don't think so. There'll be modest adjustments, but there's not going to be, in my opinion, and you can call me out on it afterwards if I'm wrong. I don't think there's going to be a deep recession here. There could be a recession for other things, like geopolitical risk, which I certainly can't control, but on the sort of domestic side, economically, and in particular to real estate and interest rates, I don't see any kind of massive correction happening anytime soon, which is a good thing. And the style of real estate you all can invest in, and I'll leave with this, there's so many different styles. And it depends on what your consultant and you as trustees really want to accomplish with the asset class. You can do core, you can do core plus, you can do value, you can do opportunistic. And each of them basically runs up higher levels of risk, and for that risk, you'll get higher levels of return. And you can select any of those styles. You can be with a manager who invests in all property types and diversifies across major markets, or you can be with somebody who's really good at targeted at specific markets or specific properties, like we only buy apartments. So there's a whole bunch of ways in which you can accomplish what you need for your boards through real estate in a variety of ways. Work with your consultants to figure out what works for your fund and what gives you the best risk-related return for your investment, and you're going to do great. We had a record year last year, as did almost everybody in our asset class. The performance in real estate was, through the roof. And I always leave with this, half glass empty comment, which is we're going to continue to do well. But it's unrealistic. We're a core fund. It's unrealistic to think that the returns that real estate got last year are going to be sustainable in the future. So again, I caution you to look at our asset class as a way of getting income and modest appreciation, manage your leverage, and you will do extremely well in the near future, and I think in the moderate future as well, because real estate has definitely earned its stripes over the years, and it's become something that is a staple in all of your portfolios. So with that, I'll answer any questions you might have and leave it on to the next. Any questions from anybody? Yes, sir.
I want to go back to office for just a second. I have to believe that your view is probably a consensus view that
Okay, great question. So far, and the question was, when a lease comes due right now on office, what are those conversations like? And typically, first of all, the winners and the losers in office so far have been the properties that are brand new or newer, that have a really awesome amenity package. They have a great gym, they have some good restaurants, they have collaboration space, things of that nature. Those buildings, the rents are going up because people are willing to pay top dollar to attract their employees back, but they have to give them something. They can't just give them the cube anymore. They have to give them something else to get them back to the office. And so that space has done really well. The space that hasn't done so well is the B space, we'll call it. Older stock, hard to renovate, hard to really get to the place where the newer stock is. That space, rents are going down. So that's definitely an issue. What's happening real time on negotiations of office leases? We as landlord, there's a lot of capital required in office. So we as landlords want the leases to be long-term, because if we're going to invest a whole bunch of capital, we want them to stay there for a long time. The pushback from tenants today is they want flexibility, they're just not sure, so they want shorter leases. So we're willing to do that, but in exchange, the tenant inducement or the improvements that we typically will give them on a per square foot basis. So let's say they're going to go into some space and they want to renovate it, the landlord will contribute some of that cost. Because they're going a little shorter on term, we're giving less in inducements. We're saying, hey, you're only in, we want you for 10, you only want 5. I get why you want 5, you want some flexibility, you don't know where it's going, that's fine. But we were going to give you $100 a square foot, and I'm making up numbers right now. We're only going to give you $25 a square foot. And you're going to need to take the space pretty much as is. Maybe we'll change out the carpet and give you a fresh paint job. So that's how the conversations are going right now. And those change over time, but that's kind of where the office conversations are going. Definitely corporate America wants a little bit of flexibility as they negotiate the leases. And we're saying, fine, we're willing to do that, but we're not going to give you as much money as you once asked for. Yes, sir.
With respect to floor layout, how has that changed renovations? I guess 10 years ago, there was a big push for kind of densification.
Yeah.
More people in less space.
Yeah.
Has that changed?
Yeah, it's a great question. The question is, has the layout of office, changed, particularly because of COVID, I imagine, and in general. And so there was a trend before COVID to what you would call hoteling in office, which meant that a lot of staff was traveling and they would be coming and going, so more than one person would sit in the same seat, okay? And there was a trend for that because that saves on space. COVID obviously really messed that up, right? A lot of employees were like, I'm not sitting in, Joe's seat, and so that's changed. And I think coming out of it, what we're seeing in new designs for office is people are carving out their own space. They want to know that that's my space, no one else is going in it, and it could be smaller, but at least I want to know it's my space. So that's sort of what we're seeing. I don't see anybody designing new space to COVID, okay? Because then that means you think COVID's going to be here forever, right? So I don't see a lot of architects putting in designs that have, the huge plexiglass walls and whatnot. I think they're realizing that at some point this will be, hopefully like a flu, and they won't have to spend that money on that kind of design. Any other questions? Yes. It's hard to see. Yes, sir.
You mentioned grocery anchored retail as being like a better area to well retail.
Yeah, well, those preparations have to happen somewhere. And a lot of the time in grocers, they've realized that they're going to lose online sales. So they're becoming an active participant in terms of preparing that and delivering it. So many grocers, they may use a third party, Uber Eats or whatever, to get it to you, but many grocers see that as a real opportunity, that people are buying their groceries, for example, and then having them delivered rather than going to the store. And the same is true with pharmacy. A lot of pharmacies now have delivery service. They'll use a third party to do it, but they have a delivery service. So I think every business is trying to adapt to the ever-changing technology and to find a way in order to enhance their revenue. So I feel like the grocers are going to be fine because they're going to take advantage of that exact trend and be able to compete against other companies.
What about the stores that are there? I think that was what the question was, is all these other stores that are relying on the foot traffic.
Yes, well, that's true. And, not everybody is buying online. As I said, only about 23% of Americans currently are buying online. And a lot of people, as strange as this sounds, a lot of people view a trip to the grocery store as a way to get out of the house. So I don't think that experience is going to go away, but certainly there'll be some challenges on a go-forward basis, especially if this takes hold more than where it is today, for sure.